start with today's action, though. Solid rally across the board. It was led by the NASDAQ, as we just mentioned. And joining us now are Venu Krishna, head of a U.S. equity strategy at Barclays, and David Doyle, head of economics at Macquarie. Good afternoon to you both. Venu, I want to get your take on this. Yes, we saw the tech-heavy NASDAQ lead the charge today. The S&P also finishing the day up. It looks like about 1.1%, 43.78. Higher from here?
I think it's going to be more of a range-bound market. We like tech. We like the AI player specifically. But that said, we think the risk-reward is asymmetric. It's difficult to make the case for a lot more upside, but macro uncertainties mean that downside is still a meaningful risk.
Okay. Venu, I mean, we got some strong data, or stronger than expected data this morning, whether it was housing, whether it was consumer confidence, whether it was some of the other economic readings. Want to get your thoughts on that and what it means for the Fed, especially on a day where Morgan Stanley has now reversed course and is expecting that July could see a 25 basis point rate increase.
Yeah, so we also as a house do believe that rates are going to be higher for longer, and probably there are a couple of more rate hikes left, which really means that, at the end of the day, we are paying significantly higher multiples in the market today than we were when interest rates were zero and growth actually was better. So I think that is going to face a challenge for the market. But in terms of the macro data, it's mixed. So there are elements, like you said, which are positive. At the same time, if you look at the leading economic indicators, you look at manufacturing PMIs, or if you look at the yield curve inversion, whether it's the 310s or the 210s, all of them suggest that there is still some risk to growth. But I think the bigger issue is we have to probably live with higher rates for longer. Right. And that probably means that we cannot continue paying the same multiples we've been paying.
David Doyle, to you now. I wonder about this market being a bit weird, particularly looking at the S&P 500, in that tech has led, particularly this year, and you've got some big tech stocks that have gone higher on AI hopes, and others haven't gone as far higher. So even if we're sort of range-bound here, even if we kind of maintain, just go down a bit, if those big stocks have run out of steam, or if there's a valuation reset, how much danger is there overall to equities?
Yeah, I mean, I would agree with the tone of that question. I think that, there is a lot of vulnerability in the market right now, not just because of the run-up you've seen in the tech sector, but also because of the macro conditions that the previous guest has laid out. The yield curve being deeply inverted, the Fed inclined to keep hiking rates, some signs that the labor market may be starting to struggle. All of that to us suggests that, the equity market may be challenged in the back half of the year.
And so, David, how should investors think about I don't want to say it's binary, like either you're in stocks or you're not, but do you take some of the gains and wait to figure out where to put them, or do you just maintain the positions that you've had, given that we're just about at the halfway point of the year, and it's one of those times when people might want to rebalance anyway?
Yeah, I think for the individual investor, they have to know themselves and know, what their own inclinations are and what suits them best. For someone who's, a long-term buy and hold type investor, you might not want to disrupt that strategy. But for someone who's more inclined to time the market, I suspect that now may be a decent time to take some chips off the table and look to redeploy them later in the year.